now. We're back. Our next guest is co-portfolio manager of, are you ready to take a deep breath? The Texas Capital Value and Growth Fund carries an overall 4-star Morningstar rating, year to date up 11.5%. Annualized return 34% over the past 3 years. That's not too shabby. Eric Barton believes the current cycle of small cap outperformance will last longer than investors expect. Joins us now here at the NYSE. Good morning, Eric. Good to see you. Why would small cap continue to outperform? Been doing it for quite a while.
Yeah, it's really about the capital availability. As long as financing is readily available for small companies, they can very effectively translate that into earnings growth. So between private equity funds and commercial industrial lending, there's really no lack of capital that's available for small caps today.
Okay, this is a liquidity question, not a rate question.
Absolutely. It's really about the quality spreads. When you see real tight spreads between junk and treasuries, that's more of a liquid environment. It's a financing environment that favors the smaller companies. And so even though interest rates have gone up, we still haven't seen the environment get terribly difficult for smaller companies.
Many people, though, do point to valuations. They talk about the fact that we're really at a premium here for small caps that we haven't really seen historically relative to large caps. Do you simply think that things are different this time around? Don't look at the premium gap?
Well, our sense is that small cap valuations are actually closer to in line with historic averages. So really the small cap run over the last 5 to 6 years was a function of valuations being at an unprecedented discount to large caps. Now that that valuation gap is closed, our sense is that the story is really more about earnings growth going forward, which goes back to the financing question that we were talking about earlier.
And labor costs, too. I mean, those are rising. I mean, isn't that, we hear small businesses are the largest employers in the United States. Labor costs, wages are rising. Are you concerned about what that will do to margins?
Well, I think that'll hurt small caps and large caps equally. But in terms of the question of small cap performance relative to large, that's ultimately going to be about financing availability.
Now, your fund is, you're neither fish nor fowl, value and growth?
Right. Well, our sense is that you can find undervalued securities in both the value indices as well as the growth indices. We're looking for undervalued growth stocks. We really don't care what index those stocks are coming out of or what style box they might be in. We have a fairly substantial exposure to international stocks as well. We just don't see any real reason to limit our investment universe to one segment of the market.
Isn't an undervalued growth stock almost always a growth stock that isn't growing anymore? That's why it's undervalued.
Well, our portfolio currently has a PE ratio of 14 on average, with a 5-year historic growth rate of about 39%. So I would suggest that that's really not the case.
Really? You can find can find GARP out there.
Absolutely, absolutely. Basically. I mean, it's not just growth at a reasonable price, but you can find growth at extraordinarily low valuations. Not so much in the large cap space, but within the broad market, there's 8,000 publicly traded equities. Well, and analysts aren't necessarily covering all those stocks, but they're fairly abundant.
Name one or two that you think qualify as growth at a real nice price.
Well, one stock that I don't necessarily have a substantial amount because it's a very small microcap, but Aldila, which is a golf club manufacturer, trades at roughly 13 times earnings and is growing at roughly 50% over the last couple of years. They do the golf club shafts for Ping and TaylorMade, other original equipment manufacturers.
Oh, they just do the shafts?
Correct. A lot of the titanium shafts, a little more of the different flexes is really where Aldila's focused. Additionally, Armor Holdings is a defense company, provides armor obviously to U.S. military. It's currently trading about 15 times earnings and is showing more than 20% growth. So anytime that we can see a growth rate that's really more robust than the PE ratio, we're fairly attracted to the stock.
All right, Eric, thank you very much. Appreciate you coming in. Eric Barton, up next, the Faber Report. Plus, what if you could play the housing market without... That was hi, Mac. How you doing? That was Mac back at headquarters. What if you could play the housing market without owning a home or even owning one of the usual housing stocks? Yale economist Robert Shiller tells us what it's all about. Squawk on the Street coming right back on CNBC.